All right, good morning, everybody. Let's go ahead and get started. Is that me? Acting, whatever that is. Technology thinking on its own again this morning. Okay, does this mic seem hot this morning? I got all sorts of technology stuff going on up here. So, okay, good morning, everybody. This seems a lot. Yeah, Marie, can I turn this volume down a little bit on the mic? Oh, you know what, Marie, I turned the volume up on here for the video. Is that what's doing it? Okay, so then I know how to fix that because I'll turn this down. Is that better? Is that more normal? Okay. All right, we'll get it figured out. So, all right, good morning, everybody. A few announcements for you. I made an announcement on web courses about this yesterday, but on Friday you will have an extra credit opportunity if you want to take advantage of it, and that is to meet with me. And I would imagine, although everybody here with me is welcome to come as well, but you guys see me I recognize most of the faces in here, so I'm seeing you on a regular basis, which I love, by the way. I would imagine that there are a lot out there that would like to come meet me and don't have the opportunity because they can't be here for whatever reason. So on Friday, I'm going to have what we're calling math chats. Okay, Kelly named that. My accounting teacher is helpful. That's what she thought that would be a cool name. So we're calling it math chat, which has nothing to do with arithmetic. But it's an extra credit opportunity for you, and I am going to be out at Reflection Pond, 4 o'clock Friday afternoon. Cut me a little slack. I'll be there between 4 and 4:15 Friday afternoon. I'll try and be there by 4 o'clock Friday afternoon. And it's an opportunity for me to meet you. And for those of you who haven't had an opportunity to meet me, if you want to come by and meet me, to do that. And we can talk about whatever you feel like talking about. I would imagine it would be related either to the course or to business or to UCF. But whatever, okay? So one of the things that I really enjoy, in fact, probably one of my largest sources of job satisfaction is meeting you guys, okay? I like talking to you. I like getting to meet you. There were a couple people up here that came up to ask me questions right before class, and I had to pass them off to Kelsey, not because I don't like talking to you, okay? It's just the nature of the course. It's hard to, with 1,000 students and just everything going on up here, it's hard to really interact with you one-on-one like I normally like to do. Okay, so that's part of the reason. That's part of the reason for this, is to try and make myself a little more accessible to you. Okay, so for those of you who want to take advantage of this opportunity, and for those who can't be at the Young Investors Club meetings at 7 o'clock on Wednesday night, this is an opportunity for you to do something outside of that time frame. Okay, so like I say, I'll be there at Reflection Pond. I'll be there like 4 to probably like 5 o'clock. The Young Investors Club has a meeting that night at, I believe it's 5:30. So I've got to be out here anyhow. All right, so I'm just going to get here early. We can come by and, like I say, chat about whatever you want to talk about. Yeah.
Is there a Young Investors Club meeting tomorrow?
As far as I know, there is a Young Investors Club meeting tomorrow. Yeah, double check their Facebook page because they're always changing things. As far as I know, there is. Whether they're going to cancel it because of the meeting on Friday, I kind of doubt it. On Friday, they have Tom Sosnoff, I believe his name is. He's the one that created Thinkorswim. Very, very famous guy in the investment arena. He's coming to speak to the club, so that's what that's all about Friday, okay? So anyhow, so that's an extra credit opportunity for you. By the way, the extra credit due date for whichever extra credit you choose to do is right before Thanksgiving, so it's the 24th. Yeah, so the extra credit is due on the 24th. So whatever it is you plan on doing, make sure you do it. Not only do it before then, you have to have your form in to the TAs by the 24th, okay? Everybody listen out there in video land, all right? That means that they have to physically be in possession of your form on the 24th, okay? That doesn't mean you do it on the 24th and turn it in on the 30th. It means they have to have your form by the 24th. Okay, I don't know how to make it any plainer than that. And also, by the way, on this extra credit, particularly like on Friday, please don't come out there on Friday and say, hey, I don't have the form, so I just wrote it down on a piece of paper. Will you take that? Okay, look, I'm doing this to help you guys, okay? I'm doing it to help your grades, and I'm also doing it to help you become aware of things that are here on campus for you, okay? So meet me halfway, print the form and bring it with you. Okay, all you got to do is log on there, pull it up, and hit print. Okay, so please don't come out there with any pieces of paper and all that kind of stuff. So, all right, so I got that. So do right before the 24th. The TAs tell me that they're still getting emails about this. I've said this like 5 times in class now. I'm going to say it one last time, and then if anybody doesn't understand it after all of this, then they're just simply not paying attention and they're disengaged. And that is, you can do as many things going, because we've got the Young Investors Club every week. There's like 4 events coming up. I think one's coming up this week with a lecture or something, one with me. You can do all of them, but you're only going to get extra credit for doing one of them. Okay, so you go to one thing to get your 1 extra credit. But the reason they're all there is because, again, they're resources for you guys, okay? So you get your extra credit for doing one of them. You don't get 20 points every time you go to a Young Investors Club meeting and every time you go to a lecture and then you come meet with me and all that kind of stuff. All right, so you get 1. All right, so like I say, I've said that, this is like the 6th time I've said this in class now. The TAs tell me they're still getting emails about it. So that's it. All right. So if you still don't know what's going on, then you're just not paying attention. All right. So anyhow, so you get 1 on that. All right. So that's the deal with the extra credit. Again, make sure you print the form on that. Also, excuse me. I posted the Chapter 9 homework. I think I set it to release, I think the first one after Thursday, because I wasn't sure how far we would get today. Okay, so Chapter 9 is Chapter 9 is really 2 parts. The first part's on the income statement. The second part's on the statement of cash flow. Okay, so for that reason, I broke the homework assignment into 2 parts. Income statement, statement of cash flow. I'm not sure if we're going to get through all of the income statement today or not. So if we do, then I'll go ahead and release the first homework today. Okay, we will certainly get through the income statement by Thursday. So worst case scenario, it'll be released on Thursday. And then same conversation with the second half on statement of cash flows. As soon as we finish that, then I'll go ahead and release that. Okay, so just be advised that that's on there, and that's coming up. And I think that is pretty much it for the administrative announcements in the course. Excuse me. Questions? Questions? Oh, yeah. Mm-hmm. I don't think there is any home. I'm sorry. Chapter 8 homework is open now. Yeah, we've finished with Chapter 8. Yep. Other questions? Other questions? Going once? Twice? Okay. One last note before we get started today. I just wanted to remind you guys, and most of you know this as well anyhow, but the TAs that I have hired for you, and for me too, but for you, I handpicked each one of these TAs. They are all 3 of them outstanding. And our baby in the group, the youngest of the group, Kelly, just yesterday got an internship offer from the CPA firm of BDO. So she will be doing an internship there next spring, not this spring. I told them they couldn't have her yet. Okay, but next spring. So she just got an internship offer on that. So congratulations, Kelly. She's probably at home in bed in her pajamas right now watching live. If she is, you'll hear this ding in a second because she'll be texting me. But congratulations, Kelly. And part of my point of that is when you go to see the TAs for help, you're in good hands. Okay, they're all 3 of them are outstanding. Okay, all right. Questions? Questions? Okay, then let's go ahead and get started. All right, so let's say Chapter 9, 2 parts: income statement and the statement of cash flow. And where we left off with Chapter 8, or one of the last things that we talked about in Chapter 8 was the notion of comprehensive income. All right, comprehensive income. And comprehensive income is actually defined in SFAS 130. I won't put that on the exam, but in that statement of financial accounting standards statement, it's actually defined as all changes in equity from non-owner sources. Okay, so you've got assets, you got liabilities, and in the equity section, they could buy and sell shares, and they can pay dividends, of course, okay, that kind of thing. But everything else in there is going to be considered income. All right, and more specifically, it's what's referred to as comprehensive income. What we were looking at last time is that when we start kind of doing the math on this, then changes in equity from non-owner sources boils down to net income and other comprehensive income. Okay, so what we talked about at the end of chapter 8 was other comprehensive income, which is going to be reported either in the equity section, or there actually companies have a choice. They can either put it in the statement of shareholders' equity, or they can have a separate statement of, I guess they call it a statement of comprehensive income. I think we saw that on one of the examples last time. Okay, so they can do it. They can do it either way, which is actually kind of an interesting issue, but beyond the scope of this course. All right. So again, OCI we talked about in chapter 8. What we're talking about here in chapter 9, at least the first half of chapter 9, is net income. Okay. All right. So just kind of for perspective, that's where we are. All right. The book gives you the difference. In fact, let me see if I can jump down there real quick. I meant to throw the slide up earlier, and I neglected to do it, I think. There we go. Okay. The book gives you the two presentations of the income statement, the single step and the multiple step. Very few companies actually use the single step income statement. Most everybody uses the multiple step. So you can assume that for everything we're going to do in this course, it's going to be the multiple step. All right. The single step, and you might see this in very small businesses. Okay, if they're not required to have, certainly not publicly traded companies, but if they're not required to have an audit or something like that, or they're preparing financial statements just because they have to and they really don't want to, then they might use the single step. And the single step is pretty darn simple because it's just revenue minus expenses. And that's it. All right, hence the name single step. And that's all well and good, but the problem with that, or the potential problem with that, is that a lot of information is lost. Okay, or a lot of useful information could be lost, which is why most companies use the multiple step income statement. All right, so be aware that there is something called a single step income statement out there, but you don't have to get real wound up about it because we're not really going to do anything with it in this course. Not that there is much to do with it. Okay, questions about that? Questions? Okay, so multiple step income statement, exam purposes, you already know this, I think. You better already know this. But exam purposes, final exam review, make sure that you have memorized the template, the basic template for the income statement. Okay, so that would be sales minus cost of goods sold equals gross profit. No, it equals gross profit. Minus operating expenses outstanding equals operating income, which is also sometimes called outstanding. Earnings before interest and taxes. Notice here they're calling it income from operations. That's the same thing as operating income. Operating income, income from operations. No worries. Okay, but also sometimes referred to as earnings before interest and taxes. Okay, and then you have interest, okay, which gets us down to earnings before taxes or income before taxes, but also be aware that other items would be in there as well. Okay, and we're going to talk about those other items here in a few minutes. Okay, so that gets us down to earnings before taxes. Taxes gets us down to net income, but there's actually one other thing that you often see on income statements, and that would be anybody? Preferred dividends. Preferred dividends. Okay. Okay. So preferred dividends also come off the income statement. So ultimately what that gets us down to is what's called net income available to common shareholders. Okay, so when we just refer to net income, it's assumed that what we're referring to is net income available to common shareholders. Okay, at the 101 level, the basic level, we kind of don't put that in, but that was back in your prerequisite courses, so we're advancing a little bit further in this course. Okay, so questions about that? Make sure you memorize that template. Of course, legitimate exam questions on here, given a whole bunch of information. Calculate gross profit. Calculate operating income. Calculate net income. So forth and so on. Okay? Questions? Questions? Okay, so starting at the top, revenue. All right, you guys all know what revenue is. I don't think that we need to go through the product, client, customers, receive. Oh, I know what I was going to say about this, is be careful here because your book, and this is true, 98% of the time, okay, that when a company sells something, they're going to receive cash in return ultimately, but they also could receive property in return. Again, especially small businesses do this probably more often than publicly traded. If your company sells something and receives property in return instead of cash, then that's referred to as? Yeah, we could loosely call it a trade. That would be a little tricky because that would imply trading securities. That's bartering. No, payments in kind is when, good thought though, payments in kind is when a company distributes property as a dividend. Okay, good thought. No, this is, your company's in the business of selling software. Okay, so you sell a bunch of software to another company in exchange for tables instead of cash. That's referred to as bartering. Bartering, okay? And in that case, you'd be surprised how many people think, and this is more of a tax thing than a financial statement, you'd be surprised how many people think that that's not taxable. Okay, it is most definitely taxable, and it would also be recognized as revenue on the income statement, but the amount of the measurement of the revenue is going to be based on the fair market value of what was received. And that's when we get into little tricky conversations. Okay, the big issue with revenue, and you're going to see this in just a minute in some examples that I have, the big issue with revenue is revenue recognition. All right, and there's two issues with that, and those are, one is, how is the revenue measured? Which is what I was just, a simple example, what I was just referring to. So measurement is an issue with revenue, and timing. Timing. Okay, a company that is getting ready to wrap up the year, earnings are down a little bit, but they have a contract in place to sell a bunch of stuff to someone. All right, and it's the end of the year, and the transaction hasn't completed yet, but their earnings are down, so they want to recognize that revenue in this year to keep their earnings up. So then the question becomes, well, have they really substantially earned the revenue? Because in one of these here, you'll see it in your book as well, is revenue is recognized when the firm has completed or substantially completed whatever is necessary to recognize that revenue. The classic example here is construction. Okay, well, they're building a building, okay, and there are different ways to account for the revenue as they're building this building. Let's say the building's taking 3 years. Okay, well, one way, and this is beyond the scope of the course, but one way would be the completed contract method, where they don't recognize any revenue for 3 years, and then recognize it all at the end. Okay? Which technically would mean that at the end of the year, if they're only 99% complete with the building, they're not going to recognize anything that year. And it would all be recognized next year. Okay? And I shouldn't have to explain to you what that would do to their earnings. Okay, so they could recognize it different ways, but again, it gets back to the idea of, well, have they substantially completed? You know, they're building a house and they've done everything in the house except they haven't put in the light bulbs yet. And it's December 31st and it's 5 o'clock and it's time to go. Yeah. So does that mean they're not going to recognize any revenue from that house just because they haven't put the light bulbs in? Probably not. Probably not, okay? So just my point is some examples of of timing issues that can be important in recognizing revenue. And by the way, this is part of, I mentioned this earlier in the course, and I think when we get into chapter 10, I want to say, don't quote me on that, we're going to talk about earnings management, okay? Very important issue, especially if you're a finance major. What is earnings management? I mentioned this earlier. We're going to talk about it later. Very important. When you declare earnings based on tax disclosures? Tax exposure. No, I think you're talking about deferred tax liabilities, I think, yeah. We're getting a group answer down here, which is fine. Help us out. Help us out. I didn't hear what he said, so give me a group answer.
Isn't it when they smooth the income statement?
Okay, yeah, earnings management is sometimes called income smoothing. All right, so probably the classic example is, let's say that a company's earnings tend to be very volatile, or they're in a business where the earnings are very volatile. Okay, well, investors generally don't like that. And financial management's job is, part of their job, is to attract investors to the stock in order to maximize the stock price. Okay? So the temptation is to take these earnings and smooth them out. Okay? And by the way, that is actually one of those, when they, with the other comprehensive income that we just talked about last week, that was when they were debating those rules. That was the argument against requiring companies to do that. Because if they start reporting all these unrealized gains, what they were arguing is that's going to make their earnings look more volatile than they really are, which investors don't like. Okay, so that was actually one of the arguments against that. All right? So earnings management is the process of trying to make the earnings less volatile, or one example of it, trying to make the earnings less volatile than they really are. Okay? And there are a number of ways to do that, one of which is through revenue recognition issues. Okay? So one of the ways they would do this is by trying to, revenue that maybe really should be recognized in this year, they kick it into next year. Okay? Or revenue that really should be next year, they try and accelerate it into this year, which is what I was just talking about a minute ago. Okay, so that's actually one of the ways. One of the ways to try and do that. Now, for the record, is earnings management legitimate? Finance majors, pay attention. Yeah, she's straddling the fence down here. She says, yes, it's legitimate, but something else behind that. Okay. What's the purpose of financial statements? Final exam review. Most properly reflect the underlying economic reality. If the reality is that your business is volatile, then that's the way it is. Okay? If you want to make your business less volatile, then find economic ways to smooth out the volatility, not just reporting ways of doing it. Because when you start doing this kind of stuff, then you're actually masking the underlying economic reality. And therefore, investors are not purchasing what they really think they're purchasing. Okay? All right. And I'm emphasizing the finance majors there because in the finance area, we talk about earnings management so much that sometimes we start thinking it's a legitimate practice. In fact, I bought a book. I don't remember if I mentioned this before. I bought a book on earnings management several years ago, and I actually never ended up reading the entire book because in the very first paragraph of the book, they said something to the effect of, well, earnings management, isn't really a GAAP procedure, and therefore it's not legitimate, but, and then they went on, blah, 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 and it's like, I didn't need to read the book because that was what I was trying to get at in the first place. Okay. All right, so those are some issues and something that's going on right now, and I am not an expert in this industry, so don't bust my chops on the details of this, but Valeant, okay, in the pharmaceuticals industry, they're apparently under fire for some revenue recognition issues, okay, that are going on. And this was the article that I came across on MarketWatch. If you Google it, you'll find lots of hits on it. Notice Valeant shares fell 40%. 40%. So that means whatever you have invested in Valeant, it is now 40% less than what it was a week ago or a day ago or whatever the time frame is here. But they're having some revenue recognition issues, and right in here, right in there, apparently part of the problem, and this is related to what we were talking about right at the end of Chapter 8, because we were talking about non-controlling interests, right at the end of Chapter 8. Apparently what they have is they have a company in which they own 50%, or own more than 50% of that company. Okay, so I was talking to Kelsey about this right before class. So let's say I am the parent company and I own 50% or more than 50% in Kelsey's company. Who runs Kelsey's company? I do. Okay. So for that reason, okay, financial statements are required to be consolidated because it's the same company. We are the same company even though we have different charters and articles of incorporation and all that. The economic reality, the substance over the form, a very important phrase, the substance over the form of the transaction is that it's the same company. Okay? So for that reason, you'll notice when you look at publicly traded companies, for example, most of the time you'll see their statements referred to as consolidated statements. Okay? That's why. Well, apparently the problem here, very common issue, is that if you think about it, okay, she has a company that I control, I have a company, I want to boost up my sales, so what do? I sell some stuff to her. And then I recognize the sales, and therefore my sales are up. Okay? Now, obviously that's not legitimate because she has no choice but to buy them. I control the company. Okay? So that's pardon the expression, a sham sale. All right, and through the consolidation process, way beyond the scope of this course, is what they deal with, is that when these financial statements are consolidated, those types of transactions are eliminated. Okay, so there's actually nothing wrong with me selling her stuff and her selling me stuff. There's nothing wrong with that in and of itself, but when the financials are consolidated, all that stuff is eliminated. Okay, because it's not coming from outside this big corporation. All right. So apparently they have some of that stuff going on in here, and there. What else? This was the 50% that I was just referring to. Okay, so that's the issue with Valeant, and what I ran across the other day, actually it was yesterday, I think, was this interview. Eli Lilly, which is also in the pharmaceutical industry, just released their earnings. Okay, and I caught this interview with the CEO, and I was thinking about you guys for two reasons. One of which is what I just talked about, and the other is that most of the issues. There's one or two things in here that we haven't talked about, but most of this should now mean something to you. Okay, so this is kind of a final exam review here. The video is 2 minutes and 27 seconds long, I think. So I want you to listen to this, and then I'm going to go back and talk about a couple things in there. And this is where I was doing the volume thing. So hopefully I get this right.
You've said before that you believe biotech is in a bubble. Do you still feel that way?
Well, I don't know if events have proven me right or not, but I said that in the context of a question that said, would Lilly go out and begin to do more M&A to buy biotechs, for example? We're going to be very careful and very cautious in this environment. I think while we will source innovation externally, there's good examples in our pipeline. Baricitinib, our rheumatoid arthritis drug, is a result of a deal we made with Incyte. But we also believe we need to maintain a strong internal research program. It's getting that balance right that really matters.
So looking out into the future, as you look to grow your company, by the way, as I look at your stock price over the last 12 months, you've done quite nicely, actually. You've had a pretty upward trend. Congratulations. But how do you grow in the future? If it's not going to be through acquisition, how do you grow it? Is it on top line? Is it further cost cuts? How does it work in your industry?
It's going to be both for us. So on top line, we have an opportunity to launch multiple products in the next 2 or 3 years. We have 2 more drugs under FDA review right now. We have other filings and submissions planned for the next 18 months. So certainly we're looking to revenue growth. On the other hand, we promised our investors we would get back to something closer to historical margins in 2018. So we're going to be focused on productivity and operating expense control as well. You can see in this quarter we've made good progress toward that goal.
John, as David mentioned, you've got a lot to celebrate, not just over the quarter, over the last 12 months. Can you help us, from your perspective, make heads or tails of this Valeant news that's out there and sort of the way this company operates in comparison to the way you do?
Well, Valeant's got a very different model than Eli Lilly. I know about the events of recent days as much as you know, but based on what's been reported in the news.
But is revenue recognition an issue in your industry generally beyond Valeant?
No, I don't think revenue recognition has been any sort of issue in our industry. Most of us sell most of our products through the traditional wholesaler channel. Specialty pharma is nothing new, and there are cases of where some products, cancer products or other kinds of specialty medicines, are sold through specialty pharmacies, but this hasn't presented any kind of revenue recognition problem that I'm aware of.
Okay, so let's go back and take a look at that, I hope. Killing me. Did I just lose it? Did I just lose it? Killing me. Oh, well. All right, so what did you hear in there? He was talking about the top line growth. What's that referring to? Because you hear that phrase a lot. Yeah. Yeah, increasing sales. In other words, the very top line of the income statement. Okay, that's what that's referring to. Okay, so he's talking about sales growth, increasing that top line. He said they had a couple of products that were getting ready to go to market that hadn't been there yet, which of course would increase that top line. He also said that they had promised investors that while they're trying to increase that top line, that they would get margins back to historical levels. What's that mean? Exactly. What's he talking about with margins? The profit margins, such as gross margin, operating profit margin, net profit margin, the things I've been harping about all semester. Okay? Because if sales grow, but expenses grow even more, then they're actually losing money. All right? So they need to increase those margins. What else did he say in there? I don't want to take the time to go back and untangle all that.
I know he was talking about sourcing innovation.
Yeah, thank you. Because they were talking about revenue recognition, and he said that, one of the things he said was that they outsourced some of their research and development costs. You'll see this later on in Chapter 9 here in the morning, but research and development, pay attention marketers, research and development, because of the uncertainty of the future payoff of that, is required to be expensed right now, in this period. But if you outsource that research and development to another company, then they're the ones that got to worry about that. Okay? Also, on kind of a related note, one of the things, because they were talking about revenue recognition, and one of the things he said was that, specialty pharmacies were nothing new, but Eli Lilly didn't have that problem because they sold through traditional wholesalers. Okay? So what was he saying there? What was that all about? And it's related to the Valeant stuff. Yeah. Well, smoothing the growth would affect it.
They're selling to outside sources.
Yeah. Yeah, they're selling to outside sources. They're at arm's length from those sources. They don't have a financial interest in it. So what he's saying is that for them, it's pretty simple, okay? They develop their pharmaceuticals, they sell them, and that's it, okay? Now, even within that, it could get complicated because when they're selling it, when it's in transportation from one place to another, exactly when does the title transfer? We talked about that in inventory, didn't we? Final exam review, what's that called? What's the issue there? Yeah. It's destination versus shipping. Yeah, the exact thing is escaping me too. What? Freight on board versus. Yeah. The issue is whether the title transfers when it's shipped or when it's received. Okay, so there still could be an issue there, but what he was saying was that specialty pharmacies are not anything new, but we don't have that problem. Well, apparently Valeant does. Okay, so apparently this intercompany transaction that we're talking about is a specialty pharmacy that Valeant is selling to, but they also control the company, which means that they can really control to a large extent their sales by determining how much the other company is going to buy from them. Okay, and that's why in the original article you might have caught the phrase that said, if all that's true, then Valeant has a lot to answer for. Okay, yeah.
I have a question for you. You mentioned how they outsource the R&D.
Yeah.
Doesn't that create a lot of problems, like who owns the intellectual property?
Yeah, outsourcing the R&D would certainly create intellectual problems, and that would be part of the details of all the transactions that would have to be worked out, which, by the way, is a good point. And that's where, as decision makers, and by the way, the CEO of Eli Lilly is a decision maker, okay, and he's paying attention to these revenue recognition issues. But when you're working out that transaction, then you've got to, you just got to work all that stuff out. So, but I mean, that's a good point, because if you owned it, but you're just having someone else do the work, then you might argue that, well, they should still recognize the expenses anyhow, okay? Way beyond the scope of this course, but a good point. Yeah?
So which one is it? Was the title transfer when the product received?
Depends on the arrangement. Shipping point versus destination. Shipping point versus destination. I can't think of the exact. I'm going to have to post an announcement about it because it's bugging me. What? Yeah. I guess it's FOB shipping point versus FOB destination. That's what it is, right? Yeah, I think FOB. Yeah, look it up in your book. Final exam review. But the issue is when and that's just part of the agreement. I mean, that's part. If I'm a seller and you're a buyer, then it's just part of our agreement. Okay, well, hey, title transfers as soon as it ships. And you say, well, no, if you do that to me, I'm not going to buy it. And we work it out. Kind of the same thing we were just talking about with R&D. Okay, all right, good questions. Other questions? Other questions? Okay, so that's kind of an overview of the top line of the income statement, okay? Revenue, and like I say, the summary of all that is really the issues with revenue is how is revenue measured and how is, when is it recognized, okay? All right, so when they do it, a very simple example, this is the entry that's going to be made right here. So when they sell whatever it is they're selling, title transfers, all that kind of stuff. Then, of course, sales is going to go up, and probably either cash or receivables will go up. Be careful. We talked about this earlier in the course. Be a little careful here, because on this particular example, which is from the book, by the way, what they say is that on March 15th, okay, when you're taking the exam or really doing anything in business, particularly with contracts, but when you're taking the exam, read the question carefully. Okay? Read it carefully. All right, there's an old saying, the devil's in the details. All right, read the question carefully, because what this says is on March 15th, Matrix sold inventory on account to a customer in the ordinary course of business. So if they sold inventory on account, of course, sales revenue is going to go up. What other account is going to be affected? Accounts receivable, as opposed to cash, because it was sold on account. All right. So be very careful. Make sure you read the question carefully. Okay. Similarly, if they had said Matrix purchased inventory on account, then the two accounts that would be affected would be, of course, inventory and accounts payable. Outstanding. Outstanding. Okay? All right, so there's your entry. And there we go, sales returns, discounts. I don't think there's anything new here. This is very common on financial statements, so you'll see what you might see on the face of the statement is this, but if you dig back into the notes, which is what Chapter 10 is on, then there will certainly be some returns and discounts and that kind of stuff. Remember the 210 net 30 stuff? Well, that would pop up right here in the discounts. Okay, so under that 210 net 30 stuff, they would still record gross sales, but then the 2% discount would be right there. Okay, does that make sense? Okay, good. All right, so that's the top line. Next on the income statement is cost of goods sold, directly related to inventory. So we talked about that quite a bit back in chapter 5, I believe it was, or 6, somewhere back in there, 4, somewhere back in there. Cost of goods sold. In this case, you don't have to get real. I told you before about perpetual versus periodic systems. You don't have to get real wound up about that, but in this case, you do need to be a little careful because when they sell inventory or when they make a sale, then if it's under a perpetual system, then 2 entries will be made. The one that I just showed you, and also they need to reduce the inventory. They need to take it out of inventory. Okay? When the sale is made. Okay? Under a periodic system, this would happen at the end of the period. At the end of the period, so they would just make one big entry right here. In fact, under a periodic system, often the way this is done is they go out to the warehouse and they actually account how much they actually have out there in the warehouse. Okay? And then they adjust inventory to whatever that amount is. Okay? Yeah.
Depending on if they use periodic or per transaction for cost of goods sold,
Yeah.
does that kind of affect how they do LIFO, FIFO, or average being?
It can affect LIFO, FIFO, and average cost, which is a good question, by the way, because particularly with LIFO, because remember with LIFO, one of the potential problems is those old layers that build up. Well, under a under a perpetual system, those layers might get eroded away quicker than they would under a periodic system. So you actually could have an issue there. I'm not going to get real wound up about that on the exam, so you know. But understanding that issue is good. And yeah, I'm not trying to make a mountain out of a molehill with periodic versus perpetual, but there can be some issues pop up, and that's one of them right there. Okay, and that was a good question. Other questions? Other questions? That was a real good question, as a matter of fact. Other questions? Okay, make sure that just like with pretty much every account that we talk about in this course, make sure you understand how this account progresses from one period to the next, which is how it goes from beginning to ending. Okay. Now, in this case, slightly different here because they're backing into cost of goods sold. But what you have for inventory is beginning inventory plus purchases. You know, we're going to monkey around with the discounts and all that kind of stuff. All right. But the gist of it is plus purchases. In fact, I could do it right there, but all right. Okay. And we got freight in and all that kind of stuff. All right. Minus, not sales, but cost of goods sold. Minus cost of goods sold gives ending inventory. So in other words, beginning inventory plus purchases, which we're going to adjust for our discounts and freight and all that kind of stuff, okay, minus cost of goods sold gives us ending inventory. Okay? Make sure you're on top of that. And like I say, really that applies for every account that we talk about, every balance sheet account. Okay. All right, questions while I catch up in my notes here and see where I am. So we talked about that. We talked about that. Question. If you have a question, go ahead and speak up while my eyes are on in the notes here. Question. Okay, so we got sales minus cost of goods sold, and this is your entry here. We just talked about this, so cost of goods sold and inventory would be affected. So nothing new there. Gets us down to gross profit. Okay, and make sure you can distinguish between gross profit and really. I think it's more common to refer to this as gross margin rather than the gross profit ratio. If you understand the concept, which by the way is the big thing that I'm trying to get across to you in this course for any given topic, if you understand the concept, then the exact label attached to that concept will not trip you up, because you understand what they're talking about, all right? I think this is more commonly referred to as gross margin rather than the gross profit ratio, but just make sure you understand their synonymous terms. This makes things look a lot harder than they really are, okay? And by the way, this is one of the margins that Eli Lilly's CEO was just referring to when he said, well, we're committed to increasing the top line, but we're also committed, we made a promise to shareholders that we're going to get margins back to historical levels. Okay, this is one of the margins that he was referring to. Okay, the gross profit margin. So here's your sales minus cost of goods sold, gross profit. So basically the first three lines of the income statement, and then they go through some things here that make it look a lot harder than it really is. And the gross margin is just the gross profit divided by sales. Okay, it's just gross profit divided by sales. No big deal. So the gross margin would be, if I may round here, 29%, 30%, and 30%. Okay. That would be a nice steady margin. Okay. Apparently, what's happened with Eli Lilly, and I have not looked at the company, but just based on what he said, apparently as time has progressed, the margins have gone up or down? Down because they're spending more money. Therefore, they're keeping less of what they sell. And he's saying, hey, we promise we're going to try and get that back to historical levels. How do you do that? Well, that's cost control. Okay, there's a whole lots of ways you can do that. One of which we've talked about quite a bit, would be to take a look at your inventory method. Okay? And maybe you want to switch from FIFO to LIFO to average cost, all that kind of stuff, which has nothing to do with the economic reality of the business. Okay, so maybe next year you're looking at Eli Lilly, and sure enough, their gross profit margin has gone back to 30%, let's say. Maybe it's gone up to 31%. Okay, well, the obvious in that is, well, yeah, it went up. That's great. Okay, but you're here to go beyond the obvious. You're here to start thinking through and going beyond what is initially not intuitive and digging into it a little deeper. And if you do that, then maybe what you'll find is that, yeah, the gross profit margin went up, but they also changed their inventory method. So the economic substance hasn't changed one iota. The only thing that's changed is the reporting. So don't be fooled. Because if it went up, stock prices are likely to pop up on that news. Don't be fooled. You go buy, and it comes back down, and you're down 5 or 10% before you know it. Okay, yeah. No, the question is when people buy the stock, they don't know how they got the numbers. They just see the numbers. That's not the way it's supposed to be. Okay. If you'll recall from back in chapter 1, one of the principles of accounting is full disclosure. Okay, so on the face of the statements, like we've been seeing, all you're seeing is the numbers. But where you get the disclosure as to how they came up with those numbers is in the notes to the financial statement, which is in chapter 10. Okay. Well, that's the issue. Whether or not people know it depends probably on two things. Certainly, it depends on how much has been disclosed in the financial statements. And that's You know, they're supposed to give full disclosure, which means if there's something that would change the views of a reasonable user, which is what we are, okay, then they should disclose it. But well, there's a whole array of ways they could get fooled. Okay, but no, your question is valid because they come up with these numbers. They're supposed to give full disclosures to how they came up with those numbers in the notes and in the annual reports, but that's, you know, how much they really give is open for discussion. Now, and by the way, that's part of the function of the auditors. Okay, I was harping on the auditors back in chapter 1 or chapter 2. That's part of their job. So Kelsey, Kelly, and Zhao, when they get into public accounting and they're out auditing your company, okay, then they're going to say, you know, well, hey, you've got this inventory issue that you've changed or whatever here. You need to disclose it. Okay, and they're going to work with you on that, but it could very well get to the point, hopefully it won't, but it could, to where if they're saying you need to disclose it, and you're saying I'm not disclosing it, then the auditors could withdraw from the engagement. And that's probably worse than getting an unqualified opinion, or I mean a qualified opinion. That's probably worse. So, you know, I guess maybe an easier way of saying all this is it's like buying a used car. When you buy a used car, should the salesman disclose all the material items about that car? Yeah. They should do that. Are they going to do it? You know, that's probably the best way to summarize it right there, yeah.
You were also getting back to what you were mentioning before, though, about reduction of expenses. Can they just do things like reduce the size of their operation, like moving corporate offices to a smaller, cheaper location?
Which would reduce their expenses.
Switch their sales program.
Well, of course.
Commission-based item.
Yeah, of course. If increasing their gross margin or any of these, really any of these issues that we're talking about in this course, if it was easy, then you really wouldn't have to take this course. You know, I mean, if it was easy, you wouldn't have to spend all this time here in college. And I'm being sincere about that because it brings up an important point. The reason you're here isn't to solve easy problems. Everybody can do that. The reason you're here is to learn how to solve hard problems. And it's our job as faculty to incrementally, as you progress through your education, incrementally challenge your limits and push you a little further and a little further and a little further, which is uncomfortable. Okay? And sometimes it's frustrating because, you know, you're trying to learn something you can't figure out, you know, it gets a little frustrating, but that's part of the learning process. So, yeah, of course, I mean, there's all sorts of ways they could increase their margins, okay? And that's why they get paid the big bucks. And that's what innovation is all about. That's also why a lot of the both tax and financial laws and rules are so complicated. Okay, good luck, those of you who are holding out for the simplified income tax system. Good luck. Good luck. I mean, I would like to see it as well, but if it's simple, then someone's going to find a way around it. And then what's the government going to have to do? Well, they're going to have to close up that loophole because they're losing a lot of revenue, which they need to operate. Okay, so they close up that one, and then what happens? Somebody else finds a way around it. You know who else deals with that? Me with your grades. And I love my job. So, okay. All right, marketers, wake up. One of the uses, I guess you could say, of the gross margin is for setting sales price, or at least that's the example they give you here. So, again, I think this is making things look a heck of a lot more complicated than they really are. Okay, so what we've got here is Matrix purchase a product, resale cost of $70. Company desires to earn a gross profit rate or a gross margin of 30%. Okay, well, first of all, let's make sure that we understand what that's saying, because we've got sales, cost of goods sold, gross profit. Right? Well, what they're saying is that they want the gross margin to be 30%. That's 30% of what? The gross margin is 30% of what? Of sales. 30% of sales. Okay. So if gross profit is 30% of sales, then cost, of course, would be 70% of sales. So far, so good. All right. So if cost is 70% of sales, you with me? Cost equals sales times 70%, barring my handwriting, which is bad enough as it is, let alone wrestling with technology. Well, they're saying, what's the required sales price? Well, if the cost is 70, $70 divided by 0.7 is $100. Okay. Now that I said that out loud, I guess that sounds just as complicated as what's up here, but it's not. It's really not. There's nothing complicated about this. Okay. Let me pause 1 second because I'm seeing a few very good students making sure they're on top of this. Okay. So from the top. Purchase a product for resale at a cost of $70. They desire to earn a gross profit margin of 30%. Okay? So the question is, how much do they have to mark it up? That's the question. Okay, they're buying it for $70. If they want to earn 30% on that, then how much do they have to mark it up? That's the question. Well, if the cost is 70% of sales, then sales, which is $100. Okay? All right, everybody with me on that? So 2 issues here. One is the math, the other is the market issue. Okay, math. We on top of that? No more? Okay. All right. Is this really the way prices are going to be set in the marketplace? What's going to set prices? Yeah. This is a good exercise to go through, and I would agree that this might be, and this is for the marketers out there, this might be a way that you determine a minimum sales price, okay? But what's really going to set prices in the marketplace is supply and demand. Okay? And my favorite example, but even with that, it depends on how saturated the industry is. It depends on how much competition is in the industry. My favorite example of this is always a pizza place. All right, let's say you're going to go open up a pizza place across Alfea Street over here on University Boulevard. Do you know how much you're going to be able to sell your pizza for? Probably, unless it's some sort of really, unless there's really some sort of product differentiation in there. If you've got some crazy pizza that nobody's ever heard of, all that, maybe you might have a little wiggle room there. But are you going to be able to sell a large pizza for $45? Probably not, okay? Because the demand's not going to be there, all right? So in that case, the question becomes, if I want to get in the pizza place, I know what my top line's going to be, okay? So can I be a cost leader in this industry to increase my margins and make it worth my while? That's going to be one issue. Okay. Now, kind of at the other extreme is when Apple, develops the iPod. Yeah. What the heck is an iPod? Okay. Nobody knew that before then, so they're in a brand new market, so demand is much more uncertain. Okay? And that's when they might come in and do something like this, keeping in mind that they would also be concerned about covering R&D costs on that. Yeah. Well, setting sales prices on iPhones, I would say, I'm certain that has evolved over time. Because now we have a more, I'm not going to call this a more mature market. Okay, so in the beginning, nobody, in fact, I was one of the original iPhone purchasers. I paid $600 for the very original iPhone. Boy, I wish I'd hung on to that thing. I won't make that mistake with my Apple Watch. This is my initial, I'll hang on to this baby because 20 years from now, all the collectors. Anyhow, I wish I'd done that with the iPhone. Anyways, and I think it was like 4, 5, or 6 months afterwards, they reduced the price to, I believe it was $300. And some of my friends were laughing at me. They're saying, hey, you got ripped off. You got ripped off. No, I didn't. No, I didn't. That was the price at that time. That was the fair market value, the price between a willing buyer and a willing seller. So no, I didn't get ripped off. Okay? That was the market value. Okay? But now, the market's more mature. And in fact, the iPhone 6s, actually going back one, because they did away with the where you could do it every year. And now I'm skipping phones because I refuse to pay him that $250 premium on it. So
phones, I work for Apple, so
he works for Apple.
So,
Yeah, give him extra credit.
phones, even if you were to buy it a full retail price, they're still $600, $700 for a phone. So
Right.
has that transition because it's perceived value of what it is. Is there a shift from what it costs because of the market, what it is for fair market, and what people willing to pay for it, that transition period?
Well, yeah, if iPhones, and I don't know if you call, but he works for Apple, so he's giving me the insider information on iPhones here. I'm sure that the cost of iPhones, cost to produce iPhones, has changed over time. You would probably know better than me. I don't know what that is. And the cost certainly would affect it. In fact, going back to my pizza example. So, well, if you want to get into pizza, yeah, you're not going to probably not going to be able to sell a large pizza for $45, but you probably could sell one for $8. If you could sell a large 2-topping pizza for $8, then you would probably have all the demand that you wanted in the area. If you could actually do that at a low enough cost to where you could still make the same margins as everybody else, then you would have a money pump in the area. That's what the term cost leader means, is you're producing something at a lower cost than all of your competitors. The airline industry is famous for this. Okay? Therefore, you can sell it at a lower price, so you're making less per pizza, but you're picking up the excess demand from that's what it's all about. That's what it's all about. Oversimplification, but that's what it's all about. Did I see a hand? Yeah.
Just back to the iPhone thing, I was going to say it's still depending on the demand, even though it's costing them less.
Yeah.
It's selling out so quickly, they're going to keep the prices up just to control the demand.
Well, yeah, and one of the things that they can't do as a business model, and it also could be illegal depending on what they're doing, again, going back to the airline industry, is selling below their cost. Okay? So this is obviously useful for that. All right? If you're going to get in a business where, and by the way, that's part of this, is what they're saying is they desire a 30% markup. Well, what if they can't get it? What if the obvious market for this is more like about $85 or $90? Then they might not, if they can't lower their cost to get down to this, then they might not get in the business. This in and of itself might determine, well, we can't afford to be in this business. So they get out of the business. Okay? Yeah.
Back to our last discussion on Amazon, they sometimes sell things for close to a loss, if not a loss.
That's true. Amazon does. And they got to be careful. That's why I say it actually could be illegal, because airlines do the same thing. And I guess it's called antitrust. Ask your business law professor. In fact, you'll talk about this over in business law. But if a company sells whatever it is they're selling below cost for the purpose of running their competition out of business so that they can then have a monopoly and raise their prices, that's a very, very general comment here. That's illegal. Okay, and I guess that would fall under antitrust rules. And don't start busting my chops about that, because I don't know. I'm not on top of the details of all that. But that's a problem in the airline industry when they start getting into these airfare wars. Yeah.
It's kind of going with what he was saying. I follow Amazon pretty closely.
Okay.
They usually lose a profit for the first 3 quarters.
Amazon losing profit first 3 quarters. Yeah.
They usually generate $250
Okay. Yeah.
Now, would that still be considered somewhat illegal? Because what they do is they put all the money into research and development.
Yeah.
For instance, drones, technology, and whatnot.
Yeah. Yeah. I would say no. He's talking about Amazon selling things below cost for like 3/4 and then starting to make money after that. No, that doesn't necessarily make it illegal, particularly if the reason they're having the losses is because of R&D. Okay, that's different.
That's what they claim.
Well, and there you go, and that's what they claim. You know, and there's a difference, and this is a quick legal example, but the same thing applies in financial statements. We were just talking about this a minute ago. There's a difference between what the law says and what the law is intended to do and the way it might play out in court. Okay? Those can be two different things, and I'm very familiar with one issue that I won't get into in here, but there's a difference between what the law says and the way things might play out in court. Okay? Yeah.
I know Amazon, another thing that Amazon claims is the reason they're doing it is to get the product in your hand so they can tell you more Amazon products and services on the device if they're selling like the Kindle.
Mm-hmm.
So, wouldn't that not make it illegal because they're going to make money off of it?
Yeah, look, I'm not a lawyer. I'm just what I'm trying to say is that there can be circumstances where, and like I said, I think it's antitrust. I don't know. I don't know off the top of my head. If you're really interested, I'll have my lawyer friend come in and guest lecture one day about it. But it can be illegal if they're selling below cost for the purpose of driving their competition out of business, so that they can then enjoy a monopoly and there is no competition. Okay. So all right. So let me leave it at that, and let's move on here. Although, okay. So we got sales, cost of goods sold, gross profit, the gross margin, which is what Eli Lilly's CEO was referring to. Next up would be the operating, or really all of the expenses, which is what this is referring to. Okay, and notice that expenses can be recognized slightly differently. I mean, generally, final exam review, expenses under the accrual method are recognized when they are incurred, regardless of when they're paid. Okay, well, some of them will be matched. Okay, because remember, the purpose of accrual accounting, one of the purposes is the matching. So the only reason a company spends money in the first place is to make revenue. Okay? So one of the big pictures here is trying to match the expenses with the revenues that generate them, that they're generated from. Okay? Okay. So they could be matched, they could be recognized in the period in which they're incurred, like administrative salaries. Okay, so obviously we need the administrative staff to generate revenue, but how do you really match what you're paying, people with the revenue? Well, in the case of administrative salaries, that would be kind of hard to do, so they're going to be allocated over the period in which they're incurred. And then, of course, the cost allocation, which would apply to depreciation. It would also apply to amortization. It would also apply to depletion. What's the difference between, what is amortization? Cost recovery of intangible assets. What's depletion? Outstanding. I'm so happy. I'm so happy. Okay, and then we start getting into operating expenses, which I guess we can pick up on Tuesday. Okay, so let's go ahead and call it at this point. So on Thursday. Today's Tuesday, right? I don't know what day it is anymore. So on Thursday, we will continue with Chapter 9, operating expenses, and we'll see how far we get. So I'm going to leave the homework. I'm not going to release the homework yet. I'll let it go ahead and release on Thursday, because we'll definitely get through it by then. Okay? All right, good class today. In fact, very good class. See y'all next week, or Thursday, or see y'all at some point in time in the future.